Hey option traders, let's talk about a commonly used option strategy today known as the iron condor. The spread is a combination of two vertical spreads known as the bull put spread and the bear call spread. That's right, it's basically a spread of spreads. So first, let's start off with the basics. As we know, there are only two types of options. There are calls and puts. And there are only two things that we can do with these options. We can buy them or we can sell them. The interesting thing about the iron condor is we're going to be doing all four at the same time. In this spread, we're going to be buying a call and selling a call, as well as buying a put and selling a put. This is a four-legged option trade. Just to clarify, we'll be focusing on the short iron condor here, which is the more commonly used one. The short iron condor is used when you have a range-bound outlook on the underlying stock. We want the stock to stay above the short put strike, as well as below the short call strike. For this trade, we are aiming to profit from the passage of time, as well as a drop in volatility. The strategy consists of a same expiration bear call spread and bull put spread. So let's take a look at an iron condor risk graph to see how this all plays out. We're looking to sell at 45 days or less out of the money put strike below support. We're also looking to buy a same expiration further out of the money strike put, which will determine and define the risk. On the other side, we're going to stick to the same expiration and start with selling an out of the money call above resistance. And just like on the other side, we're now going to buy a same expiration further out of the money strike call, which will determine and define the risk. By doing this, we've banded our profit between the short strikes. This makes the body of the iron condor. But we've also used the long options to control our risk and limit our losses in what forms the wings on the risk graph. Our max risk will be equivalent to the spread value minus the credit received. The maximum reward is limited to the premium collected. We have two break-even prices in this scenario. First, on the call side, it would be the short call strike plus the net premium received. On the other side, it's our short put strike minus the premium received. Now, a long iron condor isn't as common. For this strategy, the objective is different. Instead of expecting the stock to stay within the short strikes, like for the short iron condor, a long iron condor aims to profit if the stock stays outside of the short strikes. The trade utilizes a bear put spread and a bull call spread, and is established for a net debit. This strategy is used when you expect an increase in implied volatility. So maybe a good use case for it would be if you're expecting a big move on earnings, but you don't know which direction the stock will move. So there you have it. There are some of the basic mechanics of the iron condor, both long and short. Please remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out the new Options Trader app from IBD as well for more digestible options education and tons of great trade ideas.